I want you to remember where you were on Monday, January 26th, 2026. I want you to mark this date in your mental calendar because 50 years from now, financial historians will look back at this specific trading session as the moment the dam finally broke. We are not talking about a normal market movement here. We are not talking about a healthy rally or a standard breakout. We are talking about a paradigm shift that happened in the blink of an eye. Yesterday, the price of silver did not just go up, it crashed upwards. It surged 7.3% in a single session, smashing through the psychological fortress of $100 and closing at $103 an ounce. At the same time, gold, the silent king, crossed the $5,000 mark. These are numbers that just a few years ago would have gotten you laughed out of the room. They were the fantasies of the tinfoil hat brigade. But today, they are the cold, hard reality flashing on the screens of every trading desk from Shanghai to New York. If you are watching this, you probably feel a mix of euphoria and terror. Euphoria because you were right. You held on when everyone told you to sell. You stacked when the price was boring. You endured the manipulation and the suppression. But terror because you understand what this actually means. You understand that a 7% vertical move in a major monetary metal is not a sign of a healthy economy. It is the sound of a currency dying. It is the sound of faith evaporating. It is the sound of a system that has lost control of the one thing it needs to survive, which is the illusion of stability. Today, we are going to do a forensic analysis of what just happened. We are going to strip away the noise and look at the mechanics of this move, because it was not driven by retail investors buying coins. It was driven by force. We are going to talk about the upward crash, a phenomenon where a market runs out of sellers and the price has to teleport higher to find any liquidity. We are going to discuss the massive disconnect that is happening right now between the paper price on your screen and the real market on the street, where dealers are running out of stock and spreads are blowing out to levels we have never seen. We are going to look at the signal coming out of Shanghai, where silver is trading at a double-digit premium to the West, proving that the physical shortage is structural and acute. And we are going to talk about what you should do, because in a market this vertical, the temptation to make a mistake is incredibly high. Let's start with the anatomy of the move. Yesterday's trading session was not normal. In a normal bull market, you have a steady climb. Buyers step in, sellers step out, and the price drifts higher. What we saw yesterday was a liquidity vacuum. The price opened strong, but as it approached the $100 level, something snapped. The shorts, the entities that have been betting against silver, the banks and hedge funds that use paper contracts to manage the price, suddenly realized they were trapped. They looked at the order book and saw that there were no sellers. No one wanted to sell their silver at $98. No one wanted to sell at $99. When a short seller is trapped in a rising market, they become a forced buyer. They do not buy because they like the asset. They buy because they have to prevent bankruptcy. They have to cover their position. This creates a feedback loop. As they buy to cover, they drive the price up. This triggers the stop losses of other shorts, who are then also forced to buy. This is called a short squeeze. But what we saw yesterday was even more specific. It was a gamma squeeze combined with a physical delivery crisis. The options market had massive amounts of open interest at the $100 strike price. As the price approached that level, the market makers who sold those options had to hedge their risk by buying the underlying futures. This poured gasoline on the fire. The result was a vertical move into the close. The price didn't just drift to $103, it sprinted there. It was a panic. It was the sound of a crowded theater where someone yelled, "Fire!" and the exit door was the size of a mouse hole. This is why I call it an upward crash. It has the same mechanics as a stock market crash, just in the opposite direction. It is a failure of the market to function normally. It is a breakdown of orderly trading. And while it feels good to see the green numbers on the screen, you have to understand that this kind of volatility is dangerous. It implies that the system is breaking. Now let's look at the disconnect between the paper price and the real market. If you looked at your screen yesterday, you saw silver at $103. You might have thought, great, I can sell my stack for $103, or I can buy more for $103. But if you picked up the phone and called a bullion dealer, you got a very different story. The physical market is currently in a state of chaos. Many dealers have simply stopped selling. They have put up out-of-stock signs, or they have suspended online ordering. Why? Because they cannot hedge their inventory. If they sell you a coin today for $105, and the price gaps up to $110 tomorrow, they cannot replace that inventory without taking a loss. The volatility is too high. The supply chain is too broken. So they pull the plug. They stop trading. This means that for a period of time yesterday, The ask price for physical silver was effectively infinity. You could not buy it at any price because no one was willing to part with it. On the flip side, the bid price, the price dealers pay you for your silver, did not rise as fast as the spot price. Dealers are liquidity constrained. They don't have infinite cash. If the price of silver doubles, their cost of inventory doubles. They need twice as much cash just to keep the same number of ounces on the shelf. Most dealers don't have that kind of capital lying around, so they widen the spread. The spread is the difference between the buy price and the sell price. In a normal market, the spread might be $1 or $2. Yesterday, we saw spreads of $5, $10, even $15. This spread is a tax on volatility. It is the market telling you that it is broken. If you tried to buy yesterday, you were paying a massive premium. If you tried to sell, you were getting hit with a massive discount relative to the spot price. This is why I always tell you, do not chase the chaos. If you wait until the price is vertical to buy, you are the liquidity for the person who is exiting. You are the patsy. The time to buy was when silver was boring. The time to buy was when it was $50 or $30. Buying at $103 in the middle of a squeeze is financial suicide unless you are holding for the collapse of the currency itself. And speaking of the collapse of the currency, let's talk about gold. While silver was stealing the headlines with its 7% move, gold quietly did something historic. It crossed $5,000 an ounce. Gold is the slow boat. It is the battleship. It doesn't move fast, but it is unstoppable. When gold hits $5,000, it is sending a signal to the central banks of the world. It is telling them that the game is over. It is telling them that the debt is unpayable. It is telling them that the only way out is inflation. Gold at $5,000 means that the purchasing power of the dollar has been permanently impaired. It means that your savings account, your bonds, your pension, anything denominated in fiat currency has lost value in real terms. The rise of gold and silver is just the mirror image of the fall of the dollar. We are not getting richer. The money is getting broken. The relationship between gold and silver is critical here. Historically, when gold leads, it is a fear trade. When silver leads, it is an inflation, industrial trade. Right now, they are both moving. They are moving in lockstep, but silver is moving faster. This is the classic slingshot maneuver. Silver has been undervalued relative to gold for decades. The gold to silver ratio is compressing. As gold breaks new highs, it pulls silver along with it. But because silver is a smaller market, because it is so tight, it reacts more violently. $1 billion flowing into gold moves the price a little. $1 billion flowing into silver moves the price a lot. We need to discuss the Shanghai signal. This is perhaps the most important data point that the mainstream media is ignoring. While silver was trading at $103 in New York, it was trading significantly higher on the Shanghai Gold Exchange. There is a massive arbitrage gap. In a functioning global market, traders would buy silver in New York and sell it in Shanghai to capture the risk-free profit. This would bring the prices back in line. But that is not happening. Why? Because you can't get the metal. You cannot buy physical silver in New York and ship it to Shanghai fast enough. The logistics are broken. The inventory is not there. The West has been drained. For years, we have been shipping our silver east. We sold it to them cheap. Now we want it back, but they are not selling. The high price in Shanghai is a siren screaming that the physical shortage is real. It proves that this is not just a paper speculation event. It is a physical delivery crisis. The East is sucking the remaining metal out of the West, and the price in New York has to rise to stop the bleeding. This creates a fractured market. We are moving toward a world where there is no single price of silver. There is the Shanghai price, the London price, the New York price, and the street price. And the street price, the price you pay to get metal in your hand, is the only one that matters to you. Yesterday proved that the COMEX price is becoming increasingly irrelevant. It is a paper derivative that is losing its tether to reality. Now, let's talk about the mining stocks. If you hold miners, yesterday was a very good day. When the price of silver jumps 7%, mining stocks can jump 10, 15, 20%. This is operational leverage. Let's do the math. Let's say a mining company has an all-in sustaining cost, AISC, of $30 an ounce. That means it costs them $30 to dig an ounce of silver out of the ground. If silver is trading at $50, their profit margin is $20 per ounce. But if silver goes to $100, their profit margin explodes to $70 per ounce. The price of silver doubled, but their profit more than tripled. This is why mining stocks are explosive. At $103 an ounce, these companies are printing cash. They are debt-free. They are paying dividends. They are the most profitable businesses on earth right now. But there is a trap. In a mania, story stocks start to fly. These are junior mining companies that have no mines. They have no production. They just have a patch of dirt in Nevada and a good PowerPoint presentation. They will change their name to AI Silver Corp or Strategic Bitcoin Silver. They will promise the moon, and their stock prices will go up 1,000%. But they are garbage. They will never produce an ounce of silver. They exist only to sell stock to unsuspecting retail investors who missed the move in the real producers. Do not fall for the story stocks. In this environment, you want producers. You want companies that are actually pulling metal out of the ground today and selling it at $103. You want cash flow. You want dividends. The risk in the juniors is that they will dilute you to death. They will issue millions of new shares to pay their salaries, and you will be left holding a worthless piece of paper. Stick to quality. Stick to the companies that have the metal. I want to address the psychology of what happens next. The move to $103 is a breakout. It clears the psychological hurdle, but markets do not move in a straight line forever. After a vertical move like yesterday, there is usually a hangover. The mechanical buying dries up. The shorts who were forced to cover are done. The liquidity returns, and the price can drop just as fast as it rose. We could see a correction back to $90. We could see a flush that scares everyone. This is normal. This is healthy. Do not panic if you see red on the screen tomorrow. In fact, you should expect it. A vertical market is an unstable market. It needs to build a base. It needs to consolidate. However, the floor has moved up. We are not going back to $30. We are not going back to $50. The structural deficit is too large. The industrial demand is too inelastic. The monetary trust is too broken. The new floor is likely somewhere in the 80s or 90s. Any dip to those levels is a buying opportunity for those who missed the boat. But here is the warning. Do not use leverage. If you buy futures contracts at $103 and the price drops to $90, you will get a margin call. You will be wiped out. Even though you were right about the long-term direction, you will lose your money because you couldn't handle the volatility. Leverage is the enemy in a bull market. It kills more bulls than bears. Just hold the asset. If you hold physical silver or unleveraged mining stocks, a drop in price is just a number on a screen. You still own the ounces. You still own the shares. You can wait it out. We are entering a period of high volatility. The days of silver moving 10 cents a day are over. We are going to see days where it moves $5, $10. You have to desensitize yourself to these swings. You have to stop looking at your portfolio value every hour. If you do, you will make an emotional mistake. You will sell at the bottom of a dip or buy at the top of a spike. You have to think like a central bank. Central banks don't trade. They accumulate. They hold for the long term. They understand that the daily fluctuations are noise. The signal is the debt. The signal is the deficit. The signal is the fact that the U.S. government is adding $1 trillion of debt every 90 days. As long as that is happening, the trend for silver is up. I want to go back to the idea of return of capital versus return on capital. For the last 40 years, investors chased yield. They wanted a 5% return, a 10% return. Now, the game has changed. The goal now is simply to keep your capital, to not lose it to inflation, to not lose it to a bank failure, to not lose it to a currency collapse. Silver at $103 is not an investment in the traditional sense. It is a life raft. When the ship is sinking, you don't ask if the life raft will give you a dividend. You ask if it will float. Silver floats. The dollar is sinking. That is the only analysis you need. The chaos we saw yesterday at the bullion dealers, the phone lines busy, the websites crashing, this is a preview of what is coming for the broader economy. When the public finally realizes that inflation is not transitory, that it is permanent, they will rush for the exits. They will try to trade their paper money for anything real estate, art, cars, and precious metals. But the exit door is small. The silver market is tiny. It is a rounding error compared to the stock market or the bond market. If just a fraction of the money fleeing the bond market tries to enter the silver market, the price will not stop at $103. It will go to $200, $300, $500. We are trying to push the ocean through a garden hose. The pressure is building. So what should you trade? That is the question in the title. Should you trade the paper price? No. The paper market is a casino where the house makes the rules. They can change the margin requirements. They can halt trading. They can force you to settle in cash. Should you trade the physical market? Yes, but with caution. Do not buy when the premiums are insane. Do not buy when the dealer is gouging you. Wait for the calm moments. Wait for the dips. And remember, physical silver is not for trading. It is for holding. It is your insurance policy. You don't trade your car insurance. You buy it and hope you never need it. The best trade right now might be simply to sit on your hands. If you are already positioned, do nothing. Enjoy the show. Watch the numbers go up, but do not let it go to your head. Do not start spending the money in your mind. Until you sell, it is just paper profit. And if you sell, what do you buy? More dollars? That is the trap. If you sell your silver at $103, you get dollars. Then what? You have to put those dollars somewhere. The bank? Inflation eats them. Bonds? Rates might rise and crush the principal. Stocks? They are overvalued. You are selling the best asset to buy worse assets. The only reason to sell silver is to buy a life-changing real asset. If you can swap your stack for a house, debt-free. If you can swap it for a productive farm. If you can swap it for a business that generates cash flow. That is a good trade. Swapping it for fiat currency just to see a high number in your bank account is a bad trade. Yesterday was a wake-up call. It was the market screaming that the emperor has no clothes. The paper suppression scheme is failing. The physical reality is asserting itself. I want you to think about the people who sold at $30 or $50. They thought they were smart. They thought they were taking profits. Now they are watching from the sidelines as the rocket takes off. Do not be that person. Do not sell too early. We are just at the beginning of the triple-digit era. The volatility will try to shake you out. The news will try to scare you out. They will say it is a bubble. They will say the government will confiscate it. They will say anything to get you to give up your ounces. Hold the line. The fundamentals are on your side. The geology is on your side. The math is on your side. This move to $103 is just the validation of everything we have been talking about. It is the proof of work. But the work is not done. As we look ahead to the rest of 2026, expect more days like yesterday. Expect more upward crashes. Expect more dealer shortages. This is the new normal. The calm waters are behind us. We are in the rapids now. So tighten your grip, check your stack, and don't blink. Because if you blink, you might miss the moment the world changes forever. Yesterday was history. Today is opportunity. Tomorrow is destiny. We are witnessing the transfer of wealth from those who trust the government to those who trust nature, from those who hold paper to those who hold metal. You are on the right side of this transfer. Stay there. The price is just a number. The value is freedom. $103 is a nice start, but it is just the appetizer. The main course is yet to come. Stay tuned, stay stacked, and watch the spread. The spread tells the truth, and the truth is, there isn't enough silver.